Because our farmer did actually put on our post and ask the question. He said, look, I'm looking at doing an interest rate collar, et cetera, because I've got a lot of farm debt. Should I, hedge myself and lock in certain interest rates, et cetera? So what I do want to say is just reiterate that it's very unlikely, despite all the news of inflation, that is going to happen in the United States. But over here, it's probably more deflationary than inflationary. So don't jump on the bandwagon and lock in high rates right now because the expectation of higher rates. So I'd say be very careful. Deflation will therefore make the RBA, in fact, start dropping rather than increase interest rates to stop inflation. They'll actually potentially drop interest rates. So that's one thing. And I think that's one of the big things, especially with farmers who have a lot of debt. So that's one thing.
Welcome to the Profitable Farmer podcast, where we share stories and tips to help you run a better farming business and create your very own freedom farm. If you're looking to work smarter and not harder in your farm business, welcome. You're in the right place. Just a quick note before we get started. The following discussion is general in nature and reflects the personal opinions of our guest, Tran. It does not constitute personal financial advice. Please consider your own circumstances or seek professional advice before making any financial decisions. G'day everyone. Welcome again to Profitable Farmer. In my last episode, I interviewed Jeff McDonald just to speak on how we can navigate what's been a challenging season for so many and how to face the headwinds that are playing out for us in the industry. We're an apolitical podcast, but I couldn't miss the opportunity to call on our resident investment specialist, Tran, to help us understand the impact of the recent Trump-imposed US tariffs that have shaken the global investment landscape and certainly impacting us directly as farmers. And so in this podcast, I just want to help all of you understand what might play out on the other side of what's been imposed through those tariffs. And it gives me great pleasure again to invite Tran from Freedom Trader to join us just to explore this and understand this in detail. Terry, thank you for jumping on board again with us and for your time.
Now, always glad to be here, Jeremy, and happy to share what I know.
So, Terry, what do you make of the last couple of weeks?
To be not political and keeping that away from everything, I just think it's quite ridiculous, especially the way that it was presented and also the percentages that Trump imposed on even friendly nations like us as a country. And even our Prime Minister came out and said, if he's talking about retaliatory type tariffs, he actually did say it should be zero because we've always had a free trade agreement with the United States. And that's, sitting at 10% across the board with so-called friendly nations. But then on the ones that he did impose additional, from all the way to, I think it was Vietnam, to 48%. Which is actually quite ridiculous because I was always wondering, how in the world did he get that percentage? Does Vietnam actually charge that much on their tariffs? And then what we found out ultimately then, and what people found out, and which they couldn't believe how simplistically that it was actually thought out to be, and they couldn't believe their eyes when a lot of the academics actually and economists actually saw the calculation, was it wasn't based on what Vietnam and all other countries were actually charging them. It was in fact their trade deficit. And they use that formula based on, how much of a trade deficit that the United States has with these certain countries. And they're so taking that number and then pretty much using that to derive the percentage. And then even having the guts to say that, we're doing them a favor by halving that amount. So Vietnam would have been 94%, but we'll be friendly to them and we'll halve it at 47%. So it was actually quite amazing to see that actually happen and play out with this whole thing. And hence why a lot of the stock market, but also I think a lot of businesses in the respective countries will be quite damaged if this actually goes ahead. And I think it is going ahead within the next 48 hours, pretty much, from the time of this recording.
Do you see each imposition as negotiable between nations, or do you think that Trump's going to hold his position?
I think for the majority, he's definitely going to hold it. And he actually has said that multiple times. I know that Vietnam, Cambodia, Israel, and even Taiwan have reached out and according to him, 50 nations have reached out to negotiate. But sometimes I do wonder, how do they actually start negotiating? Because the number he put out wasn't actually even a true and correct figure. So if it was actually true and those nations did charge that, then there could be a number to work out and get to a percentage that works for both. But in this case, it was actually just trade deficit. And if you think about it, trade deficit, there is no way that a emerging country like a Vietnam, for example, could ever buy the amount of goods that the Americans spend on those third world countries. There's no way. There will always, in fact, always be a trade deficit. So the way he calculated was actually quite amazing, the way he did it. But then, being able to publicly release that out and create quite a bit of havoc with the markets, but also global economies now.
What do you make of the China response and that in the last 72 hours?
I think we're heading into a very dangerous road, and that's going to affect Australia as well. And I say that because I always talk about, surface level thinking, but second level thinking. And I want to explain that too. Firstly, obviously, he's put on board, China's already had, I believe, 2 multiple 10% tariff policies in the past couple of months. So he's whacked on 10. China's retaliated and said that we'll be kind. We're not going to do it across the board like the United States. They'll do it in certain industries. And they've done that. And now Trump's come back with a 34% on top of that, which now takes it to 54%. And China, in response, then came back and said, look, if you do that, we'll do 50. We'll also add on 34 as well. And Trump has basically put on his Truth Network in a social post saying that if you retaliate with the same 34, we're going to whack on top an extra 50, which is really taking it to ridiculous levels now. Then China now, as of the last couple of hours, pretty much within the last 12 hours, they've come back and said, look, let's not play this tariff game. We know you also need our stuff as well, which really in the end, I think Trump probably forgot all about this, is China is in fact, I believe 80 to 90% of rare earths that comes from China. And rare earths is the material. There's about 6 to 7 metals that is required to produce from silicon chips to the military equipment. And they're actually banning that. They're making it so hard for the United States to actually take that, to be able to export or import that from China going forward. So although America has a bit of stockpile, which will last them maybe up to 6 months, beyond that, they're going to have a problem as well. And I don't think Trump actually thought that through when he did that. So now it's a matter of, who sort of, and, for both of them, they want to save face. So now it's a matter of who actually now wants to go to the negotiating table, but also potentially they don't want to look weak in front of each other too.
So how have you seen this impact the economy, local and global, in this last week, Terry? What have you seen and what are you telling your members?
Yeah, thankfully we've been, saying for 3 to 6 months now that our market has been overvalued for a long time. So make sure that we don't fall in love with stocks, things that are way overvalued, take profits. So, recently we held even Berkshire Hathaway, Warren Buffett's company, for quite some time, about 3 or 4 years now. But we sold it. We literally sold it out because it was seen as a safe haven, went overvalued, and we sold that. And many other stocks that were overvalued, we started taking profits and making sure that we've got cash. So on both the investment and long-term trading, we had about, myself and a lot of our students had between 25 to even up to 60% cash ready for the potential fallout of this. We didn't know how bad it would be, but of course we're seeing it right now unfold. How it would affect the global economy, though, will depend on certain sectors, but also certain countries as well. So, for example, take even, say, our Aussie beef right now, and he's somehow targeted that in his speech. And straight away, it'll be whacked on 10%. Whether that gets added, we don't know, but let's say 10%. So straight away, our exports will, the price of beef towards the United States, they've got no choice but to probably increase the prices and not, there's no way Aussie beef farmers could absorb the entire 10%. So that's one thing. But what I would say is that if the United States puts up this is where I talk about that second level thinking. On the surface, it looks like it's going to be very inflationary for the United States, where things, even despite what he says, no, things are going to go down in price, etc. We're bringing manufacturing back to the United States, etc., etc. But what he forgets is that the moment that he puts these tariffs on board, everything that goes into the United States will jump between 10% all the way to, 47, 48% on top of what their people are paying. And there's no way small businesses, medium businesses are able to absorb that type of rate. So they'll put that across. So I think the biggest losers, ultimately in the end, at least the short to medium term, is going to be the United States consumer straight away up front. And I don't know how long that's going to last, but it will be a while. And then the moment that happens, though, obviously the demand for Chinese goods or Vietnamese goods or wherever that these tariffs have been slapped on, they become expensive. A lot of Americans then won't be buying those goods. They'll probably try to source it elsewhere. But then what happens then is, let's say take China, for example. They do a lot of trade with the United States. And all of a sudden, if all those goods don't go to the United States, they still need to find a home. And he's still in production is still going. There will be a lag time. They'll slow down production, but in the meantime, there's still going to be continued same production. Those goods then will then have to go elsewhere besides the United States, and they'll flood the entire world, which means Europe, definitely Australia for sure. So what we're going to find is inflation in the United States, which people think, and then they think that even from the surface level, we'll think that, oh, it's going to be inflation in Australia. Not necessarily. What's going to end up happening is that the flood of goods and cheap Chinese goods into our country is going to basically, rather than inflation, probably have deflation, in fact, electronics, things like that. And then on top of that, of course, our exporters and, the own manufacturers probably who produce these type of goods will probably have a hard time competing with these cheap goods coming from flooding our country as well. So I think it's going to also have a ripple effect of creating potential unemployment because the companies just can't afford to continue having these workers when their demand is also down too.
So the flow-on effect then on inflation and interest rates. Terry, do you hasten to make an assessment on what you think?
Yeah.
It's starkly different, isn't it, to only 4 weeks ago?
Yes, very different because a month ago, I literally just said, look, it's unlikely the RBA is going to do too much because they're waiting to see what Trump actually does before they make the next move. So they've held quite steady. I think it's still sitting at 4.35 at the moment. So they did have that one decrease and they've just held steady. Whether they needed that is a different story, but they've done that. And then I really thought that they are not going to have a move for a while now. Having said what I just said, where we may, rather having an inflation, which obviously interest rates will rise to combat the inflation, if we actually in 6 months' time, we end up seeing deflation, which I believe the RBA is not silly. They're anticipating that. If there's going to be deflation, then the next move come May, there may actually be another potential interest rate drop. In fact, because of that. And depending on how bad it gets, we'll probably see another 1 to 2 drops in the on top of that this year in 2025 as well, just to combat this whole and rebalance this whole thing that's gone into deflation.
Exports into the likes of China and into Asia, they're a major trading nation of ours. What would you say about commodity prices into those major trading nations?
I think it's going to be weak, and it's not because we of our prices, etc. It's going to be weak because China really does, and the United States, they rely on each other, no matter how you put it. I think it's even ourselves, 70% of our stuff literally goes there, of our GDP goes there. So if their economy, which already has suffered because of the property crisis they've had in the past 2 years, you may have heard of all the giant property collapses and people losing their money in their savings, etc., because Chinese just love property versus, say, shares. So their economy has been weak because of the wealth effect, where people have lost money. They're unwilling to spend as much as they used to 2 or 3 years ago, because back then they did feel wealthy. Now they don't. But now if the United States pretty much shuts their doors on China, and China can't have their goods there, their manufacturing is going to slow down. They'll probably have, unless the government takes some drastic action of stimulus, which they do, and I've seen it many, many times, but that's really short term. But long term wise, it doesn't really solve the problem. So if the companies start losing money and they lay off workers and people just can't afford the goods, then what ends up happening is consumption drops, and of course, what happens there? They don't need as much exports from us as they used to. So therefore, lower demand. We've still got the same supply, but lower demand. And of course, our prices on commodities will probably see a drop as well.
So 2 questions, if I could. Are there some ag sectors that might benefit where larger tariffs are imposed on our competitor producers?
Yeah, I don't know what the exact... This is going to depend on certain sectors and which countries produce who are the main suppliers to, for example, to the United States. So I know, for example, almonds. We do export our almonds, but we are not a major export at all. So I have heard that there are other countries which do produce a lot more almonds than us, and their prices are definitely getting whacked up by 30 to 40%. And that's going to benefit us. So I think it's going to be very certain sectors, like, say, almonds, are unique and specific. And if their prices are higher over there, obviously the wholesalers, the retailers, they'll look for cheaper alternatives, and then they'll come to the cheap alternative. And if Australia is the one, they'll take more exports from us.
Thank you. And what advice are you giving, or what comments are you making to your members around investing, or in the short term, given what's playing out? If they haven't converted to cash yet, that's something that needs to be a priority, or what would you have your investors do?
I'll go on to the big topic first, which was what we already covered. Because our farmer did actually put on our post and ask the question. He said, look, I'm looking at doing an interest rate collar, et cetera, because I've got a lot of farm debt. Should I, hedge myself and lock in certain interest rates, et cetera? So what I do want to say is just reiterate that it's very unlikely, despite all the news of inflation, that is going to happen in the United States. But over here, it's probably more deflationary than inflationary. So don't jump on the bandwagon and lock in high rates right now because the expectation of higher rates. So I'd say be very careful. Deflation will therefore make the RBA, in fact, start dropping rather than increase interest rates to stop inflation. They'll actually potentially drop interest rates. So that's one thing. And I think that's one of the big things, especially with farmers who have a lot of debt. So that's one thing. The next, on the investment front, we've been always saying that the market's expensive and ensuring that you've got that sort of buffer of 20-25% cash if you can. So what I would say is if you already have a portfolio and you don't have that amount of cash, what you may want to do is look at some of your so-called blue chip shares, even if they're Australian, assess the stocks, see if they are still of quality. That's one thing. But even if they are of quality, see if they're overvalued. Great example. This morning, I literally sold Woolworths. So Woolworths, no doubt, a blue chip, great company. I've held it for a couple of months. It was really only a trade. Nothing wrong with Woolies at all. However, it's one of the stocks that just don't get affected by market because everybody still has to go grocery shopping, etc. So they're one of the defensive type stocks. So they are still sitting quite pretty. And those ones haven't moved much. So if you don't have a big cash cushion and you want to take advantage of the opportunities that's coming up, then you may actually want to, despite it being quite hard to sell off good stocks, if they're overvalued, which Woolworths is overvalued by quite a big margin, you might want to look at the portfolio and sell down those stocks to ensure you've got cash to take advantage of the other stocks that are far cheaper at the moment. And I'm talking about multiple sectors, from US banks to pharmaceuticals to the tech sector, AI that everybody's been talking about. They've dropped 30, and in some cases 35% in the past couple of months, which is ridiculous now. And they're now undervalued. And technology and AI is not stopping anytime soon. It's still going to continue on. Might slow down, but it definitely won't stop.
So where else do you see opportunities for investors right now, Terry?
I would say also it hasn't dropped as much. Say even the farming equipment manufacturers like John Deere and Caterpillar. So they've dropped about 15 to 20% so far, especially Caterpillar. That's dropped even more. So that's on our watch list at the moment and waiting for a further drop and more drops. And we sold out of John Deere a while back at close to its high. Thank God we did. But now we want to actually buy back in, but it hasn't dropped enough yet. So, even getting into industries that, most of our farmers are familiar with, the equipment manufacturers, the stuff that you guys use, those companies, if they're listed and they produce the products you use, have a look at them. If the numbers make sense and they're undervalued, don't overlook them. Like, even though it's in the same industry, it might feel risky because you're already in farming. But if they're undervalued, farming is just like cycles. The stock market's like the farming cycles too. There are downs, which we are now, but there's going to be a reversal too.
What's your comment on exchange rates, Terry, given this?
Great question. I totally forgot about that one to mention. I mentioned it this morning in our post in Facebook. The US dollar is always seen as a safe haven for when, things go wrong in the world. So whenever there's an uncertainty, US Treasuries is the so-called, or seen as a so-called safe haven asset. And of course, to get into US Treasuries, which billions of dollars transact every day to get Treasuries. To get those, though, you have to change into US dollar. And therefore, the US dollar, if you may have seen, if you've looked at the charts, you would have seen the US dollar strengthen dramatically across the globe, but especially with the with the Aussie dollar as well. So it's quite high. In other words, if you have US dominated assets like US shares, you're okay. You've been hedged. But if you have, in fact, a lot of, say, US dollars that's sitting there, not yet, but it has been quite elevated, and there may be a chance, which I am actually doing myself in the coming days or week, to sort of change that US dollar back to the Aussie dollar, the cash position. US shares I already got plenty, and therefore I'm technically already US dollar based on the share portfolio. But because I've sold so much US shares of late in the last couple of weeks, I've got a lot of US dollars sitting there as well, and they've gone up in value. And what I will be doing myself personally is I'm going to be swapping that US dollar back to the Aussie dollar at these type of high rates.
Do you see the US dollar deflating given what you've talked about?
On the surface level, it actually feels like, because the US is going to like a dramatic decline, it feels like it should be. But funny enough, it's not, because it's still the global currency that everybody uses to trade, as in global trade. So, and therefore, it's no matter what, unless things change, who knows in 5 or 10 years, that there's another global currency. But at this point in time, the banking system relies on pretty much, the US banking system, the SWIFT network, etc. So they still see the US dollar and United States somehow as still the safe country. And that's why people flood to that.
And Terry, for those inputs that our farmers call on out of America for production, fertilizer, ag chem, and other, is there a clear line of sight as to whether we're going to be paying more for that, or does that depend on how our government retaliates?
I personally don't think our government is going to retaliate. Funny enough, obviously the US economy is the largest in the world, plus China, 1 and 2. That's why it's so important that these guys down a track, don't know whether they'll become buddies, but at least get to an agreement that they don't take this any further, because 1 and 2 fighting just is not good for the world. But in regards to what you just asked, is that our trade to the US, I believe it was only about 4.6%, I think, our trade with the US. So it's not a massive amount. It is still substantial, but it's not massive. And I don't believe that our Aussie government we don't have the size and the power to retaliate, because if we do, I think it's going to be more painful. And that's why our government has already come out and said, like, we're not going to retaliate. There's going to be a common ground. And I'm pretty sure we'll come to some form of agreement rather than 10%. Could there be something that's more friendlier? Because ultimately, in the end, we've been friends for that long, and US military bases in Australia, etc. So we do cooperate quite a fair bit with the United States. So I can't see that we can't get to the negotiation table, unlike many other countries at the moment, which just aren't friends with the United States.
Without being alarmist, where could this go?
I'm hoping that the countries, or actually Trump, in fact, comes to the senses and allows that negotiation to happen. I know 50 nations, according to him, has reached out. And I do hope that there is some form of agreement that it doesn't get worse, not that it already isn't. And if this goes, tit for tat, and it gets worse, especially with the bigger nations, I think the smaller nations simply can't do much. The Vietnams, etc., which, funny enough, a lot of the US companies like the Nikes, the Apples, they've slowly, over the past decade, they have actually already slowly wanting to divest from China to ensure that they're lowering their risk, because all their production, that's why Apple's dropped like 20% in the past week, basically, because of the tariffs. Since most of their iPhones and Mac PCs, they're still coming from China and Taiwan. So they want to reduce that, move it over to countries like India and also Vietnam. But then these countries are also getting hit with these massive tariffs as well. And of course, they don't have the same power as China to retaliate. They're going to the negotiation table to find out, is there something we can do for you? And let's lower our rates. So I think that part's going to be eventually fixed up. But if it gets worse, especially with the major nations, China, US, and the EU, if it gets worse, my hope is that it doesn't become a full-blown trade war where all the free global trade that's occurred in the last half a century since World War II, we don't want to see that thrown out, and every single country has their own barriers now. And then it makes it much harder, where it's no longer free trade, where countries will now start having different rates, creating complexity, but also having different rates between different countries, which I don't think is a good thing at all. Yeah. There's something that I do, which I have heard about, and which I'm hoping it does not happen, is the back end of, World War II was also a bit of a trade war. And I'm hoping that it doesn't get to that stage where, it's not just now about trade, but it's also about power and military power as well.
Terry, we've got other key Asian trading nations, Japan, Singapore, you mentioned Vietnam and other. You've touched on the China-US relationship, but how do you see our relationship and our trade dynamics changing with some of those second-tier Asian nations?
I think that if we don't get what we need, and we've already seen this among other nations, where obviously every nation has differences, and even Japan and Vietnam and South Korea, they've had differences with China. But recently, from what I know, is because of the high tariffs that these guys have been slapped on, they're actually now actively talking to China and wanting to work together with China, which is not surprising, because when I always say, when one is bullied, And actually, when multiple are bullied, then the ones who are bullied, then they sort of become friends to get a better outcome. And I think potentially down a track, we could end up being a nation that ends up, if we are ever asked as well to be part of that group, to also, to ensure that we are diversified and not always about the United States as well, which we have called for a friend for half a century.
So you mentioned US potential economic downturn and potentially similar in China, and the tension between those two key nations might escalate. How do you see that playing out? What's your synopsis for the general global economy?
I am hoping that it somehow gets to a certain stage where it just stops and then they do come to the table. There is no sign of that at this point in time. However, if it keeps on going and gets worse, then we as a nation who does export, China is a very big trading partner of ours. And there's no doubt if United States, but also more in particular, if China is affected dramatically, then we are definitely going to be affected, from the amount of demand that they want from our products because their economies are shrinking. So it's going to affect us in a big way. I know the Treasurer, Jim Chalmers, has come out and said that, they acknowledge what's happening with tariffs. And I think he's put a bit of a positive spin where he says that there's probably this is his words, a 0.1% reduction in GDP, and this part I don't agree, a 0.2% rise in inflation. And I talked about second level thinking, there would probably be deflation instead. And he said, despite these challenges, a recession is not anticipated. If things keep on going as they are, I do believe the United States and China is going to go into I don't know how long, but at least a mini recession for a couple of quarters. And that would then drag our economy down by a couple of quarters as well. Because you are talking about the two biggest trading nations on the planet. And if they're not friendly with each other, and it will definitely drag the entire world down along with it, plus the EU.
Thanks, Terry. It's just amazing to find ourselves in this situation, isn't it, really?
I'm actually quite surprised that something like this could actually go through. Never thought, especially these type of rates, we've experienced, 10, 15 maybe % type tariffs, but not seeing countries with whacked on 30, 40, and even towards 50% tariffs, which is literally, it's a full-blown trade war, the way he's done it.
Terry, it means that we've got to look at investing in 2025 and beyond fundamentally different to how we looked at it in 2024. Can I ask you to speak to the difference?
No, for sure.
And then I guess my second part to that is, when the marketplace is fearful, it creates real opportunities. So I know we've got a webinar coming up with you that I'll speak to shortly, but I guess it probably highlights the opportunity to be proactive rather than reactive as an investor and to skill up, if you like, so that you're ready to take advantage of opportunities that might come on the other side of this crisis.
No, for sure. How this year is going to be different, it's big because the last 3 to 4 years now, we've had really good returns. I think it's what we don't want to become as an investor or trader is become complacent because even my accounts, if I look at it, we have had 25 to 30% per year returns the last 3 years straight. And even in a down year in 2022, it was, I think, 12%, but the market dropped by 20%. So we've had this quite stable environment throughout the last 3 to 5 years easily. 2025 will be different because as we're seeing unfold right now, things have gotten out of hand where not only myself, what I'm saying is a lot of the investment community has become complacent and used to 15, 20% returns. And they thought this will last forever. Things have been going out of hand. They were becoming very expensive, overvalued, so to speak. How I'd like to say is, let's say your farmland, it's worth, say, $5 million, but someone's pretty much offering you $8 to $10 million for the farmland. It's overvalued. What would you normally want to do? Probably sell it out to them. And you think that the farmland's actually worth 8 or 10 million because someone's willing to pay for it. But it's really only worth 5. Now we've gone into the reverse scenario where your farmland's worth 5, but someone's so pessimistic they're offering only 2 to 3 million. So they're basically asking for a bargain and discounting the actual true worth of the farmland. So that's really what's happening with the market right now. And 2025 is a time where, one, we have to be more defensive for sure. Select, and which we've always done anyway. Only make sure you select very quality companies that would not only survive but prosper during these times. And there are many out there. There are companies that, if they're not profitable in the prior years, what makes you think that they're going to be profitable now? They're actually going to go backwards even further. So we want to definitely avoid those type of companies and just go for the very quality ones. And then on top of that, what I would probably say is understand valuation and know what you're paying for it and know the value of it. The last thing you want to do is accidentally pay too much, because if you pay too much, you are adding on top risk. And when there is a decline, you'll see your share price decline, go down even faster, but will probably not recover as well. Whereas if you buy something of quality and of value, even though you might see a temporary setback, it's actually okay, because see that as an opportunity to buy even more of a quality stock because they're at low prices, almost like a sale at Woolworths or Coles. You go there and use like your favorite groceries on sale, buy more of it. You know you need it. You know it's cheap. Why not take the 30% off or 40% off product that's on the shelves? It's the same as what's happening now. And in 2025, we are going to have the opportunity, and important that we don't miss it, because I always say, and this is not even my quote, it's Buffett's quote, be fearful when others are greedy, but be greedy when others are fearful. And people are getting very fearful at the moment. Because if you look at the CNN Fear and Greed Index, it's sitting at basically 4 out of 100. A year ago, it was sitting at 80 to 90, and now it's sitting at 4. So the entire world is very fearful of what's happening around the world because of all the headlines, etc. So we want to be contrarian and be upskilled, ready for it, and don't be scared. Take advantage of the opportunities, because they only happen every 5 to 10 years, like a COVID or like a GFC. When they happen, that's actually, in fact, post these events, these calamities, so to speak, you'll see generally the best returns from post these type of periods. And they set you up very well for the coming years, because you get that big kick of capital gains all of a sudden. And then, if they're overvalued, you can sell down, and all of a sudden you've got this tidy lump sum to then now spread and get into the other stocks as well.
Thanks, Terry. So a couple of times a year, we ask Terry to put on an exclusive webinar for our community, and that is coming up. So just check in the show notes the timing for our next upcoming investment webinar with Freedom Trader, where Terry will teach you the key principles that you need to be across to learn and get ready for the opportunities that are at play in the investment landscape in the medium term. Yeah, Terry, thank you very much, as always, for putting on those exclusive events for our members.
No, a pleasure, Jeremy. And I love running them. And and hopefully I can bring value to a lot of our farmers, and help them create sort of another income, and also asset base as well, and not just the farm itself.
Terry, my last question to you is, with all that is being sort of put out in media, it's hard to know where to get the best intelligence at this time. I know the Wall Street Journal's a key resource for you, but what are 2 or 3 key resources that you would recommend investors are focusing on to get the best information now that is dependable?
I would say definitely not the the nightly news type thing, but more towards the the real financial publications. As you mentioned, Wall Street Journal is definitely one of them. The other one, if you're also interested on global headlines and very, I would say, safer investment type, proper journal writing, is a magazine called Barron's is another one, and and one that we have at home, the AFR, Australian Financial Review.
Great. Terry, it's amazing that we find ourselves in this situation where just in the last couple of weeks, a major imposition incurred on the global economy by one individual. It's just amazing that it's happened. But thank you for helping us understand it. Thank you for sharing your comments on what it might mean for the Australian economy and our farmers. Thanks for reminding us that this is the time when proactive investors might get ready to take advantage of opportunities.
No, a pleasure, Jeremy, as always, to be here. And great to be, very timely for this chat as well.
Thanks, Terry. And to all of you, look forward to seeing you on Terry's webinar in a couple of weeks. Thank you again, Terry, for putting that on.
Thanks, Jeremy. Talk soon.
Take care. It's quite amazing to find ourselves all of a sudden in a global economy with significant trade tariffs imposed by the US. Helpful, I think, for Terry to jump online and help us understand it, and to help us understand the impact that that's going to have on the global economy, on the relationships between major trading partners, and the impact back on the Australian economy and on our farmers and on all of us as passive or active investors. It seems like we're going to have a softening economy. It seems like the Aussie dollar might drop relative to the US. It seems like interest rates might go south before they go north. And it seems like inflation might slow, and we might actually move into perhaps a deflationary environment. So we all need to prepare for that, especially as farmers, and make sure that we are proactive in how we're setting up our farms given that new environment. Terry, thank you for joining us to help us understand that. Let's hope that this plays out favourably between our major trading partners over coming weeks. And to those of you that are really active and wanting to be active in the equity investment landscape, I recommend that webinar coming up early May with Terry Hiley so that you can get ready, learn the principles, and get set to take advantage of some opportunities that might come from what's playing out in the global economy. Terry, really appreciate your time, and take care, everyone. I hope you found this session useful. Bye for now. Thanks for listening to another episode of the Profitable Farmer podcast by Farm Owners Academy. If you're new to this show, be sure to follow us. If you've been a long-time listener, let your friends know about us or come continue the conversation in the Profitable Farmer Facebook group. All the best as you grow your business and create your freedom farm. Until next time, keep being incredible.